Stock markets around the world going through this wave of volatility though, and this worry that we're seeing on a daily basis. There has been a flight to safety, investors piling their money into the bank. We're joined now by Bill Keogh, joining us in fact from FIG Securities in Sydney. Bill, good to chat to you. We have seen a lot of volatility in share markets. How have you seen all of that being affecting the deposit markets, which you're watching?
Yeah, good morning, Brooke. Yeah, it's quite bizarre that we're talking about our deposit market when the global stock markets are in this sort of volatility. But as you mentioned in your intro, that clearly there's been a flight to safety, and that means people have been selling stocks and buying the fixed income asset class, and especially I think the winner out of this is really your liquid short-dated securities such as term deposits and even at call cash. So the rates are still very attractive in that part of the curve, and we've certainly seen a movement out of stocks into cash.
One of the interesting things we've been watching is kind of a breakdown in some of the traditional relationships we expect to see on a daily basis. One of the discussions that keeps coming up is how equity and fixed incomes are following or not each other in past weeks and months. What are you seeing in terms of that relationship right now?
Yeah, sure. The correlations between markets are difficult to forecast, but certainly if we look at the last 6 months, the end of last year when we did have some volatility, we saw stocks move inversely to fixed income. So stocks rallied, fixed income prices came off, or interest rates went up in bond markets. At the beginning of this year, in 2011, with the market steadying, we saw that correlation break down, but certainly in the last month we've seen that correlation come into play, and hence pressure under stock prices. And from the FIG perspective, we're certainly seeing more inquiries coming into our to our asset class being fixed income, and also a lot of people are still looking at call accounts.
Okay, so you believe that interest is at the expense of, say, equities?
Well, certainly in the media, Citibank was in the paper saying yesterday that they have seen the recent week around $6 billion globally come out of stocks and move into a safe haven, being bonds and cash. I suppose what I'd debate is they think this is going to be short term, so people are selling stocks, putting their money on the fence and just waiting for the volatility to go out of the market and look at buying back into the stock markets. On the flip side, I've read just this morning some other stockbrokers are seeing a clear asset allocation move, where a lot of their investors are looking to change their weightings in the asset allocation and moving more into a safe haven of fixed income. So I suppose you've got this. Risk on, risk off, as risk on buying stocks, risk off selling stocks, and equivalent on the other side moving into cash and bonds. Timing of markets are very difficult. So I suggested over time that the asset allocation will move in the favour of fixed income.
Do you see dividend payouts as competition maybe for you guys in the fixed income space? Because I mean, there's some very good dividends being paid, and then people can look potentially to get some appreciation on the share price as well. Is that something you think people are weighing up when weighing up whether to go shares and fixed income?
Yeah, sure. Well, when they look at dividends through shares, the equivalent in the bond market is the coupons, and there are very attractive coupons in bonds, in corporate bonds, actually in some of your more liquid bonds such as semi-governments. So you have to look at the dividend payout from the shares first, the coupon payments in the bonds, and you rightly mentioned the capital of the underlying securities being stocks or bonds. Well, that's typically where you get to win or lose on a mark-to-market basis.
I know that you've been seeing returns in term deposit rates being affected a little bit with all of the moves in the past couple of weeks or so. Do you at all see the attractiveness of term deposits waning?
To answer your question, I don't see it waning. I think we've been pretty consistent with our story over the last few months when you've been talking to us about the term deposit market, that the underlying is that our the financial institutions, so all the approved deposit institutions, being the banks, the building societies, the credit unions, they still have an appetite through their asset liability book for retail deposits. And certainly with the new Basel III regulations coming into play, that also supports the competition in term deposits. And also the rating agencies have been quite vocal about their concern with the banks relying on wholesale and offshore funding. So I think those three things really support that term deposits the attractiveness of term deposits will be here to stay for some time.
Thanks so much, Bill. We appreciate your time.
Okay, thanks very much, Brooke.
Bill.